How's it going, everyone? Bill Lethman here for Money Evolution. In today's video, I'm going to be talking about ways that you can save more money for your retirement. But before I get into that, I think really the bigger question that we should be asking ourselves is, do we actually need to save more money for retirement? Or is our retirement already on the right track and we don't really need to save anymore? So to answer that question, I actually created a free workshop called the Retirement Time Machine Quick Start Workshop. I'll put some links down in the description below. We're going to run through some worksheets and help you get organized with all of your different retirement resources, walk you through some simple calculations and some worksheets to really uncover that question. Is your retirement on track? And if it's not, how far off track are you? And what are some of the adjustments you can make to your goals to get that retirement back on track or saving more money? And that's what we're going to cover in today's video. So check out the links down in the description below, and then we'll get into the topic of today's video. Okay, so if you've fallen a little bit behind on some of your retirement planning goals, there's really just a handful of things that you can adjust or make changes to that's going to help you get back on track. One of those is you can delay retirement, so you can work a few more years. You can spend less money in retirement, or you can save more money between now and your retirement date. And that's what we're going to really talk about in today's video. So one thing that I've really noticed as we're doing a lot of financial planning for our clients is that as you get a little bit closer to retirement, your cash flow changes quite a bit. So if you think about it, let's say you've got kids, and as those kids start to go into college, move out on their own, some of your expenses are going to go down naturally as a result of your kids becoming more self-sufficient. You're not spending money on the kids anymore. Also, too, you might have things like your mortgage that's getting paid off. You might be hopefully getting increases in pay at work, and your salaries are going up a little bit. And so the difference or the gap between what you're earning and what you're spending and all of those expenses tends to grow a little bit larger as you get closer to retirement. And that's a good thing. But what we're going to talk about in today's video is how can you make the most of that, and how can you take some of that extra cash flow that you have and really put it to the best use in saving that money for your retirement. And I'm really going to cover about 5 different things here in this video. So the first thing I want to talk about is your 401k plan that you have through work. And I think most of you probably or hopefully are already maxing out your 401k plan, but it goes without saying that you should work towards maximizing that 401k contribution, especially if you're a little bit behind on some of your retirement savings. So for 2023, you can contribute up to $22,500 if you're under the age of 50, and if you're over the age of 50, you can actually do a catch-up contribution for another $7,500, bringing that total up to $30,000 per year. So contributing the maximum to your 401k plan is going to be one thing. Also making sure that you're getting the match. So even if you're not able to fully maximize the total contributions to your 401k plan, you should always be making sure that you're getting that matching money. That's free money that your employer is giving you for making those contributions to help you for your retirement. So you want to make sure that you're taking advantage of all of that. Also, too, this is still a little bit of ways away, but beginning in 2025, with the Secure Act 2.0 that passed in late 2022, they made some provisions for catch-up provisions. So beginning in 2025, they're going to now increase that catch-up contribution for those that are age 60, 61, 62, and 63. Just for some reason, they just did it for those handful of years. But you're going to be able to do the greater of either $10,000 of a catch-up contribution or 50% greater than whatever the catch-up contribution is for that particular year. So these contribution limits tend to go up a little bit every year with inflation, so they made some provisions for that. So making sure you get all that money into your 401k plan. If you qualify, another great option, I think, for saving more money for your retirement is going to be making Roth IRA contributions. So if you're 50 years old or older, you can do up to $7,500 in a Roth IRA. If you're under the age of 50, that number is going to be $6,500, so that's a $1,000 catch-up contribution there also. There are going to be some income restrictions to that. So if you're filing a single tax return between $138,000 and $153,000, they're going to start to phase out your ability to contribute to that Roth IRA account. And if you make more than $153,000, your ability to contribute directly to a Roth IRA is going to be completely eliminated. If you're married filing a joint tax return, those numbers are going to be $218,000 to $228,000 is going to be that phase-out period, and then over $228,000, you're going to be restricted from making a contribution directly to that Roth IRA account. You can, however, do something that we've talked about before called a backdoor Roth, and that involves basically making a non-deductible contribution to a traditional IRA account and then immediately converting that over to a Roth account, which would be a tax-free event. And you can do this at any age up to the limits, and it's going to be the same limits for a traditional IRA account, that's $6,500 or $7,500 if you're over 50. But one thing you do have to be very careful of is if you have any existing IRA accounts, even if you opened up a brand new one, the IRS is going to look at this as all of your IRAs collectively. And so if you have an old IRA account, maybe you did a rollover or you contributed to an IRA account back some years ago, they're going to look at all of this collectively. This IRA account might include some pre-tax money. And if that's the case, when you go to do that Roth conversion, you're going to end up having some of that money be taxable. It gets into a much bigger conversation here on how that actually works. But if you have existing IRA accounts, it's probably going to complicate it to the point where it's not going to make sense. But if you don't have any other existing IRA accounts, I think that's something that could make sense for a lot of people. One thing I'll mention on this too, though, is that if you are married, you have a spouse that maybe you have some old IRA accounts, but your spouse doesn't, you might be able to do that backdoor Roth strategy for your spouse, even though you can't really do that for yourself. So think about that a little bit. Also kind of going back up to what we were talking about with the 401k, also make sure your spouse is maximizing their 401k benefits as well. And I think that's very important. Sometimes people don't really think about that, especially maybe if their spouse maybe is just working a little bit part-time, maybe they don't have a whole lot of income. You may not be thinking about maximizing their 401k plan, but what you could do is you could help to increase those contribution limits, even if it really drastically lowers your paycheck. And I think that's something that a lot of people don't really think about there. And you might even say, well, hey, if I lower that paycheck enough, I won't have enough to cover any of my bills. So one of the things we talk about is shifting assets from things that are less tax efficient to things that are more tax efficient. So for example, you might have some money in non-retirement accounts. Those are things like bank accounts, maybe regular brokerage accounts that are not part of any IRAs or Roth accounts or 401k plans. And so you might have some money here. You might have $100,000 or so, and maybe you want to maximize your 401k, but that paycheck is going to be less than what you actually need to cover some of your bills. And so what you could do is you could just simply shift a little bit of money. Let's say you're coming up $1,000 a month short. You could just simply shift some money out of that non-retirement account to cover that, but you're effectively shifting money from that non-retirement account to something that's going to be more tax efficient, like a 401k or doing your Roth contributions, whether that's directly or through that backdoor method or whatever that may be. So be thinking a little bit about that. Another thing I want to talk about here that not everybody is going to have access to, but there's a lot of 401k plans. I think the statistics are somewhere maybe between about 40 or 50% of 401ks allow for something called an after-tax option. And so that allows you to actually go above those regular 401k contributions. In fact, actually for 2023, if you're under the age of 50, that allows for a total contribution into your employer-sponsored plan up to $66,000, and if you're over the age of 50, that's going to be $73,500. And what that is, it's a combination of your regular contributions. Remember, that can go into both Roth. Get that right there. Roth or traditional, and that can be, let's say you're over 50, that could be up to $30,000 per year. And then you might be getting some match, and maybe you're getting $10,000 of match there. So you're putting between those $40,000 in there. And if you're over the age of 50, that would give you another $33,500 that could potentially go into that after-tax bucket. Now, why is that a big deal? Well, that after-tax bucket is going to be a tax-deferred bucket. So as it grows, you won't be paying any taxes on that. You'll pay taxes when that money comes out. So it works kind of similarly to some of the traditional IRAs and 401k plans. But in 2014, the IRS made a very favorable tax ruling on that now allows you to take those contributions to an after-tax account, and then you can roll those directly to a Roth IRA, or if your plan allows it, you can even roll it to your Roth portion of your 401k plan. So you move that money over periodically throughout the year, once a year or a couple times a year, depending on what your plan allows, and you're actually going to be shifting that money directly into a Roth IRA. There's no income limits on that, so you don't have to worry about getting maxed out on that, and it allows you to really go much further above and beyond some of those regular 401k limits there. Another thing that people don't always think about right away is going to be your HSA account. So if you have a high deductible health insurance plan, you probably qualify for a health savings account. And if you do, it's really a great option for you to save some additional money, not necessarily specifically for your retirement, but for health care. But let's face it, we're all going to probably have health care throughout our entire lives. And as we get a little bit older, we're likely going to be bigger users of those health care services and things. So for 2023, if you're having a single plan for healthcare insurance, you can contribute up to $38.50 per year, and if you're on a family plan, that's going to jump up to $77.50 per year. And that money goes into the account tax-free. So you get that to deduct right off of your income. And it also grows tax-free, and also it comes out tax-free as well. So as long as it's used for a qualified medical expense, you can pull that money out, plus any growth that you might have earned in the account, because you can invest it kind of similarly to other types of retirement accounts and mutual funds and things like that, depending on what your HSA allows for there. But really, it's going to be what we call triple tax-free. Tax-free going in, you get a deduction, you're going to grow it tax-free, and you're going to pull it out tax-free as you need those for those qualified medical expenses. So don't ignore that HSA. That could be another great way that you can save some additional money for your retirement. Okay, so I hope that was helpful. I hope you got some good information out of today's video and learning about some ways that you can save some additional money for your retirement, especially as you're maybe getting a little bit closer to retirement. Maybe your cash flow is improving a little bit, and if your retirement is a little bit off track and you need to save some extra money, this is going to be some ideas that you can be a little bit more efficient with how you save that money. So if you haven't already, be sure to check out the links down in the description below. Check out our Retirement Time Machine Quick Start Workshop. It's a great place to start. It's totally free. I think it's all maybe just a little bit less than an hour to go through the worksheets. We're going to help you get organized, walk you through step-by-step calculations to see where you're at for your retirement. Are you on track? And if you're not on the right track, we're going to talk about some ways to get back on track. If you've already done that, or you want to take a further step, we have our Retirement Time Machine program, which is going to not only do that, get into a lot more detail, but also walk you through what I sometimes call the 7 core elements of retirement planning, looking at things like Social Security and understanding your retirement gaps, planning out retirement withdrawals, income tax optimization strategies, and things like that. So we'll have a link down below for that as well, or you can go to retirementtimemachine.com to learn more about that. So thank you very much for watching. I'll see you back in one of our next videos.